While purchasing life insurance policies, it's almost normal to be overwhelmed by all the products and services that are available in the marketplace. Unfortunately, the way the industry is structured, consultants normally receive a commission on the product that is sold. So you need to ensure that the product that is being purchased is actually in your interest versus in the interest of your consultant. One thing to consider is if you are part of the masses, which means employed, working with an organization, expect to retire at the age of 65, there needs to be a consideration about whether there is a need for life insurance beyond that age of 65. The whole idea behind retirement at the age of 65 was that life expectancy at that point in time may have been 70, 75, or 80. The purpose behind the whole retirement conversation was that if somebody retired, they are assuming that the assets that they have created till the age of 65 now are in a position to derive an income that can allow them to take care of their expenditure till they passed on. A thing to consider now is if you are not going to be reliant on an income other than that being generated from your assets beyond the age of 65, then do you require a life insurance policy that outlives the age of 65? One reason that people choose to purchase life insurance policies beyond the age of retirement, whether that is 65, 68, or 70 in your mind, is are there any liabilities that need to be addressed beyond that point of retirement? In some cases, you might own property in jurisdictions that basically attract an inheritance tax. So one reason to have life insurance policies last beyond the age of retirement is to ensure that any inheritance taxes are paid off and the assets now become the property of your next of kin. But for the masses, like I suggested in the beginning, it may make more sense to consider term insurance. Let me talk to you about what is the difference between a term insurance and a whole life policy. A term insurance policy is a lien life cover only. It could have riders as critical illness and disability. The point I'm trying to make is that this policy has got zero investment value associated with it. It's almost like you're purchasing a motor insurance policy on your life. And this is what keeps the policy lean and cheap. If you look at a universal life policy or a whole life policy, this contract has money invested in various asset classes or indices, the returns of which pay for the cost of insurance over the years. So when we talk about a 4%, a 5%, or a 6% growth rate in these whole life or universal life policies, you have to bear in mind that the product also deducts the cost of insurance on a yearly basis from the plan. So a typical 5% within a life insurance policy may not be the same as a typical 5% within an investment product, because the investment product would have the 5% growth without having to take care of any cost of mortality charges, versus your life insurance product would give you a 5%, but from that there would be a deduction for cost of insurance. If you look at the difference in premiums, an average person aged 35 would roughly pay about $16,000 a year for what we call a whole life insurance policy for $1 million, with the payment term roughly at about 15 years. However, if you had to purchase the same contract or the same level of cover of $1 million till the age of 70, it would probably cost you as little as $3,800 to $4,000. The difference between the two numbers is about $12,000 a year. Consider this. In your first option of purchasing a whole life insurance policy, the policy will last till the age of 100 or even beyond. The policy endows to a value of $1 million, which basically means, God forbid, you passed away, the payout to your family is a life insurance cover of $1 million. However, if you survived till the age of 95 or 100, the policy would still pay out an encashment value of $1 million. Versus that, a term insurance policy is super cheap, very cost efficient, and pays out the $1 million only in the event of death till the age of 70. However, the additional $12,000 a year that you're saving on the side, which is the difference between your lean term insurance product and your whole of life plan, is something that can be put aside into a separate investment vehicle which grows year on year and can pay between 2 to 2.5 times more than that $1 million coming out of a life insurance policy. So consider whether you really require that big universal or whole life insurance policy if you form part of the masses. Consider whether there is actually a need for that. In most cases, you would be fine to purchase a term insurance contract and have it bought for the maximum amount of term, put the difference of money in a separate regular savings portfolio or an investment plan that can grow year on year. If you consider the savings and term insurance proposition, now in the event of death, the payout is still $1 million from your life insurance policy. Hey, but guess what? Your investment portfolio has got a residual value as well. And in 15 years, that money could be as much as $200,000-$300,000 more. Another question you need to ask yourself is, would you ever consider purchasing a motor insurance policy that also invested some money in equity markets? And if the answer is no, and you form part of the masses that don't require insurance beyond the age of 65, 70, or whatever that planned retirement age is, then consider, do you need the universal life or the whole life insurance policy? The second thing I'm talking about over here is ensure that you do not have any liabilities that still need coverage. One way to hedge yourself against this is, if you know retirement is going to be for you at 65, don't purchase your term insurance till 65. Maybe plan to purchase till 70. Give yourself a little bit of a buffer. Of course, at the age of 65, if you decide you don't need the coverage anymore because your assets are all completely paid off and debt-free, cancel the term insurance policy, and you just don't end up paying for the remaining 5 years.